Something doesn't add up here. Since January 2022, mortgage rates basically doubled.
Home sales fell around 40%, which is the kind of drop you'd normally see in a full-on housing crash.
And active listings? They more than doubled, up 142% across the country. Every single thing that's supposed to drive prices down went off at the same time. Rates shot up. Sales tanked. Inventory came flooding in. That's the textbook setup for falling prices. That's the scenario buyers have been sitting around waiting for, some of them for years now. And yet, price per square foot climbed 11.5% over that same stretch. In 42 out of the 50 biggest metros in the country, prices are higher right now than they were in January 2022. Which brings up a really uncomfortable question. If every force that was supposed to pull prices down was going full blast and prices still climbed, what exactly is propping them up? First, the 70-year construction slowdown. It turns out the answer goes way further back than most people realize. It goes back to a construction slowdown that's been grinding on for 70 years. Research by Harvard's Edward Glaser and the University of Pennsylvania's Joseph Giorco, published in the Brookings Papers on Economic Activity, points to the core problem. We just haven't built enough homes, and the numbers make it pretty hard to argue otherwise. Back in the 1950s, the housing stock in the US was growing at roughly 4% a year. We went from 36 million units all the way up to 86 million by 1980. But by the 2010s, that growth rate had cratered to 0.6%. The country basically stopped building at the pace people needed. That's the foundation everything else sits on top of. Every other force we're going to get into, the pandemic spike, the lock-in trap, the inventory illusion, all of it plays out on top of a country that was already millions of homes short before any of it kicked in. Second, the disappearing safety valve. For decades, there was at least a release valve. If your city got too pricey, if New York or LA squeezed you out, you could pack up and head to Phoenix, Dallas, Atlanta, Miami. Good job growth. Housing you could actually afford, space to breathe. That was the deal. But Giorco warns that those Sunbelt metros are starting to look a lot like the coastal cities people were running from. Phoenix's annual housing stock growth dropped from 9.1% in the 1970s to just 1.0% in the 2010s. That's creeping right up next to LA, which has been stuck around 0.5% for decades. The affordable boomtowns are turning into the next expensive, supply-starved markets. And Giorco put it like this: it wasn't so bad when the coasts became supply-constrained and incredibly expensive, because people could move to super high job growth cities with affordable housing like Atlanta, Phoenix, Dallas, and Miami. If this goes away, it will be the first time in American history where we don't have affordable housing markets with high job growth. The mental map most of us carry around, the one that says, well, if things get too crazy here, I can always move somewhere cheaper, that map is being redrawn right now. And for a lot of people, the cheaper place they had in mind is already gone. Third, the pandemic price reset. If the country went into 2020 already short on homes and losing its safety valve, the pandemic was basically gasoline on a fire that was already burning. Existing home prices jumped 54% nationwide since 2020. And that's not what people were asking. That's what buyers actually paid. The price-to-income ratio hit close to 5 times median household income, compared to the old standard of about 3 times back in the 1990s. And this really hits your actual paycheck. The monthly payment on a median-priced home went from around $1,700 in early 2020 to $3,100 by the fourth quarter of 2025. Same house, nearly double the payment. And for a family earning the national median income, that's not just a number on a chart. That's the difference between qualifying for a mortgage and getting turned away, between building equity and staying stuck renting. The pandemic didn't just push prices up for a while, it reset the floor entirely. And everything since then has been measured from that new, much higher starting point. Fourth, the affordable housing wipeout. So if the price floor got shoved up 54% and locked into place, who got completely shut out? 7 million rental units that used to cost less than $1,000 a month have vanished over the past decade, either lost outright or converted to higher rents. Homes listed for sale that were affordable to households earning $75,000 or less dropped 60% between March 2019 and March 2026. The bottom rung of the housing ladder got yanked away. And according to Harvard's Joint Center for Housing Studies, after paying rent, the lowest income renter households, we're talking about 13 million households pulling in under $30,000 a year,
have a median of just $210 a month left over for everything else.
Down from $410 in 2019, adjusted for inflation. $210.
That's groceries, gas, medicine, childcare, a phone bill for an entire month for 13 million households.
Fifth,
The lock-in trap.
now you might be thinking, okay, if prices are this high, why aren't existing homeowners cashing out? Why not sell into the highest prices in history? Because they're stuck. Over 50% of outstanding mortgage holders are locked into rates below 4%. So selling means giving up a payment they can comfortably afford and taking on one they might not be able to handle, even if they're moving to a cheaper house. According to Realtor.com's analysis, the lock-in effect doesn't cancel itself out. It actually makes the remaining competition fiercer because the buyers who are still out there shopping tend to be moving out of necessity, all fighting over fewer available homes. And the data backs this up. Nationally, new listings are up just 1.7% over 4 years. In the Northeast, they're actually down 13.5%. The Midwest, down over 10%. Sellers just aren't putting their homes on the market. The pipeline is barely a trickle. Sixth, the inventory illusion. So then where is all that inventory coming from? Active listings more than doubled. If sellers aren't listing, how is inventory growing? Because it's not new supply showing up. According to Realtor.com's data, the rise in inventory is driven by homes sitting on the market longer, not by more sellers deciding to list. In January 2022, new listings made up about 86% of active inventory. Fresh homes constantly cycling through. By January 2026, that share had fallen to 36%, barely a third. So that inventory number splashed across every housing report. The one you've been told is flooding the market. It's mostly the same homes sitting unsold, month after month after month. The supply you were counting on to bring prices down was a mirage. It was stale. And there's one more mechanism. What happens when a seller does list but can't get the price they want? According to Realtor.com, a lot of sellers are choosing to just pull their home off the market rather than drop the price. And that withdrawal of supply is exactly what prevents the price drops those sellers were trying to avoid in the first place. Delistings as a share of active listings went from 3.1% in January 2022 to 7% by January 2026. But the sharper number is this. As a share of new listings, delistings jumped from 8.4% to 32%. Nearly a third of new listings get pulled off the market instead of selling, and many of those sellers just relist later, waiting until they can get their price. Every single one of those delistings removes a home that might have been the one some buyer could actually afford, and its removal makes every remaining listing a little pricier. Seventh, the volume crash that nobody noticed. And all 7 forces come together here. Total existing home scale in 2025 hit 4.063 million, the lowest since 1995. 30 years of transaction volume, just gone. The crash everyone's been waiting for? It already happened. It just didn't show up in price. According to Realtor.com, what we got was a volume correction, not a price correction. Sales collapsed, but prices held firm. The market absorbed the entire force of doubled rates, disappearing demand, and surging inventory. And it absorbed all of it through frozen activity, not through lower prices. Only where inventory exploded to truly extreme levels, like Austin, where listings nearly quintupled, did prices actually come down. For anyone who's been waiting this out, the market has already shown you what it does under maximum stress, and it doesn't give the price back. So what would actually need to change for this to get better? Realtor.com argues that the path to real, lasting affordability needs something very specific. Lower mortgage rates have to unlock existing homeowners' willingness to list, which would add supply even as it adds demand. They call it a balanced spring. But there's a risk. Realtor.com warns that if mortgage rates drop without a matching jump in new listings, what you get is another price surge that wipes out whatever affordability gains buyers were hoping for. Lower rates without more supply just means more buyers chasing the same scarce homes. Some sellers are starting to budge. The share of listings with price reductions climbed over 8 percentage points nationally since 2022, and even more in the South and West. But individual price cuts don't fix a problem this deep in the structure. According to Realtor.com's analysis, the 3 things worth actually watching are stronger new listing growth, firmer pending sales, and a drop in delistings. If those 3 move together,
If supply genuinely expands alongside recovering demand, then the affordability gains from lower rates have a real shot at sticking. And on the structural side, according to Harvard's Joint Center for Housing Studies, states are starting to take steps. Arkansas and Iowa legalized accessory dwelling units. Kentucky opened single-family zones to manufactured homes. Florida, New Hampshire, and Texas are allowing multifamily in commercial zones. It's early. There's no data yet on how well it's working. But the fact that legal barriers to building are starting to crack, that's at least a sign that structural change isn't impossible.
I think the instinct most of us have is to wait for one big thing to fix all of this.
A rate cut, a crash, some policy announcement that changes everything overnight. But this video walked through 7 forces that are all tangled up together, some of them 70 years in the making, and not a single one of them has a simple on-off switch. So the frame I'd leave you with is this: watch the structure. Are new listings actually growing in your metro? Are delistings going down? Is supply genuinely expanding, or is the same mirage just repeating itself? That's where the real signal lives, in whether the structure underneath is actually shifting. Because until it does, the math doesn't change. And the math is what families are sitting with at the kitchen table. If this was useful, hit like, subscribe, and tell me in the comments. Are you seeing any of this play out where you live?